Good afternoon. My name is Mark Wolstoncroft. I'm a senior manager on our audit and assurance group, and Erika Deiseroth is a manager in our audit and assurance group and is joining me up here this afternoon. I don't know if you know this, but this 2 o'clock slot is it's like the most coveted slot for all the presenters, you know? I mean, everybody is wide awake, ready to learn. I guess there's a reason they have cookies after this slot out back. So, I mean, at least you have that to look forward to. Erika and I are happy to be here this afternoon to talk a little bit about revenue recognition. It's a topic that impacts pretty much everyone in the room. And if you feel a little bit like you're in Groundhog Day, you know that movie where the guy keeps living the same life over and over again? Erika and I have been up here. I think this is her 4th time in a row speaking about revenue recognition in some way, shape, or form. So we think this will be the last year we're up here speaking about revenue recognition. Don't clap. Don't clap. But really, the first year, was in the GAAP update, and we were kind of getting rolling with revenue recognition, and it's been kind of a long time on the runway in terms of getting off the ground with revenue recognition. But last year, Erika and I really took a deeper dive at revenue recognition, and we really walked through the literature pretty deeply and looked at a lot of different examples with you. Today, really what we're going to try to do is look at some implementation issues. We're going to go quickly through the 5 steps. Hopefully you're pretty familiar with the 5 steps for revenue recognition now. And then we're going to look at some implementation examples for, number 1, for a construction contractor. Number 2, for somebody who would have some multiple deliverables, like a software company. And then lastly, we'll look at like a construction contract or engineering firm company that might use percentage of completion basis of accounting. As we walk through this morning, if you're following along in your binder, you should be able to track pretty closely with what we're talking about. We will have one segment that's on the screen that's not in your binder relative to the manufacturing example. So again, the objectives, just to refresh on the 5 steps and then talk about implementation considerations.
Okay, so I'm going to kick us off here to talk about ASU 2014-09. I don't think I can call it the new revenue recognition standard anymore, given this is my 4th time speaking on it. It's going to be codified in section 606 in the standard codification. So just to touch quickly on the applicability of the standard. So this is applicable to all contracts with customers with a few exceptions. Lease contracts, and that's something that Jeff and Jason spent some time on this morning, not under the scope of this revenue recognition guidance. It's not applicable to insurance contracts, to financial instrument contracts, such as an interest rate swap agreement, that kind of thing. Guarantees do not fall under this guidance. There are certain warranties that Mark and I will touch on later on that are part of this revenue recognition guidance. There are also certain non-monetary exchanges to which this guidance does not apply. So just to move then into a little bit more about the standard, I'll turn it back over to Mark.
Sure, this really is sweeping change. They basically blew out all of the old revenue recognition literature, all of the industry-specific information, and replaced it with a principles-based approach. And for the most part, it's largely converged with IFRS. There are some small differences. For example, they've already implemented IFRS for private companies, whereas 2018 is really the year for us. And there are some other minor differences, but for the most part, it's converged.
Okay, so getting into effective dates, so public entities, it's actually this year, calendar 2018. So we do have a break after this. I'm hoping to hear some inspiring stories from people who are with public companies and have already worked on implementation of this new standard. When it comes to non-public companies, you guys, effective 1/1/19, are going to have to start implementing this, thinking about it. Hopefully what Mark and I share with you today will help you do that. Also, Mark would not let me play Final Countdown coming onto the stage, but that's what I want you all in private companies to think about. We're really getting into that final countdown, finally, given how long we've been talking about this. Early adoption is permitted starting in calendar 17, so would be an option for you this year as well.
Yeah, so just a reminder on the 5 steps. First step, identify the contract with the customer. Erika came up with these keywords, I think 4 years ago. Her keyword here is agreement. Step 2, identify the performance obligations. Those performance obligations have to be distinct performance obligations, as you'll see as we walk through some of the implementation guidance. 3, determine the transaction price, and there we're talking about the consideration that's transferred. 4, allocate the transaction price to the separate performance obligations. The key there is at standalone prices. When we're allocating, we're doing it based on standalone prices for the different performance obligations. And then lastly, when control transfers, we're going to recognize the revenue as we satisfy each performance obligation.
Okay, so this next slide is showing the core principle that's sort of behind those 5 steps, and what we're going to do now is show how that core principle bears itself out in 3 different industries, starting with manufacturing.
Yeah, so first we're going to work through a pretty simple manufacturing example. Those of you who are already in manufacturing and have already started to consider this, you might be thinking to yourself, this doesn't have that big of an impact on our company, but we want to walk through some of those. In order to do that, I'm going to play the well-prepared CFO of our hypothetical manufacturing company, and Erika is going to play her professional, helpful, practical CPA self. So excuse me just a moment while I get into character. I don't go to many offices where I have CFOs wearing ties anymore, so I figure I can have an excuse to take off my tie. Okay. All right, Erika, I've done my homework. I've walked through the 5-step process for revenue recognition. I've even written a memo about the 5 steps and how it applies to our companies. I think I have it all sorted out, but I want to run it by you just in case I'm missing something. As you know, we're a metals-based manufacturer. We buy metals, we process metals, we sell processed metals, and everything is manufactured to order. We don't really build anything to inventory.
Okay, that sounds good. So getting into step 1, identifying contracts with your customers. What did you think about there?
Well, I think that's pretty simple. Our contracts are largely standard sales orders. We offer a payment discount. Ownership clearly transfers upon shipment, and we offer a 90-day warranty. And then finally, we do have that one customer where we provide, volume-based rebate depending on how much they buy. Can you think of anything I'm missing?
No, I think that pretty much covers it in terms of identifying your contracts. So just to reiterate, there are 5 criteria to consider when you're trying to determine whether you do have a contract, and it sounds like you've thought about those things. Those 5 criteria are that the agreement has commercial substance, it's been approved, the rights of the parties are identifiable, the payment terms are identifiable, and collectability is probable. Based on what you're describing to me, it sounds like your sales orders do meet those first 4 criteria, and you also have a good collection history. I'm aware of that just by working with you the past few years, so I think step 5 is covered there too. So how about step 2?
Well, I think this seems pretty simple too. Really, I think our only performance obligation is the shipment of products. But we do have that 90-day warranty, and I know that some warranties can be treated under this literature and some warranties are treated under other literature. How do you see that 90-day warranty being treated by other companies that you work with?
Yeah, that's a good question. So revenue recognition methods will vary based on whether you have a warranty that's maybe just an assurance warranty versus a service warranty. So in general, an assurance warranty, like what you're describing to me, would not be considered a separate performance obligation because that's really going to be wrapped into the sale of that product. Whereas if you have some sort of warranty to provide service to those goods that you have already shipped to your customer, then that really is a separate service and you would account for that as a separate performance obligation.
So it's easy for us, though.
Yep, exactly.
Okay.
You can keep using the current guidance on guarantees and the codification to account for your assurance warranty.
Okay, I think step 3, I think we have 3 pieces to the transaction price as I see it. I mean, obviously we have the amount that we're invoicing to our customers. We also have the discount that we're offering, and there's that rebate arrangement we talked about. I'm expecting you're going to tell me that we have to record some sort of reserve for the discount and the rebates. Can you tell me a little bit more about that?
Sure, yeah. I think we should break this down a little bit. So the guidance speaks to fixed consideration, which would be your invoiced price, and then it talks about various types of what the guidance refers to as variable consideration. So in this case, both your discount and your rebates would fall under that category of variable consideration. So what this guidance, new guidance allows is that you can estimate based on your company's history, based on other things, what those variable pieces would do to your transaction price and recognize revenue net of those pieces. So just to give an example here, if your invoice price is $100,000, then your discount, that discount would be offered on early payment by the customer, maybe within 15 days. If they do that, they get a 2% discount. If you know that that's taken on about 60% of sales, that gets you to that 1.2% shown on the slide. And then similarly with your rebate, maybe you offer something where your customer, if they purchase a certain volume, they get a 10% rebate at the end of the year. That point, you can kind of use an estimation process, and there are a couple of these laid out in the guidance. This one's called is the expected value method to determine, okay, what would that rebate, how would that impact revenue recognition? So for those of us in here who do think about things in terms of journal entries, your receivable in this transaction would be $100,000. You would then have some sort of a reserve for a sales discount of $1,200. You would have some sort of rebate liability for $8,000, and then your revenue is going to be that net $90,800.
Good, thank you. I think on step 4 and 5 seem pretty straightforward too. We don't have anything to allocate since we only have the one performance obligation.
Right.
And I guess step 5 is pretty clear too. Control passes upon shipment, so when we ship, we'll recognize the revenue.
Yep. So some observations from that process that Mark and I just embarked upon. This was a pretty straightforward example. We didn't want to get too complex, just to lay out those steps. From an accounting standpoint, that's reasonably consistent probably with how that transaction would be accounted for under current GAAP or under existing GAAP. Potential exception of revenue being reported net under the new guidance, whereas maybe in the past you would see some sort of expense rather than a net down to revenue, which is what we illustrated here. I will say though, even if the accounting isn't going to change for your company or your industry all that much under this new guidance, it is possible, or I do know that the disclosures will be changing. There will be more required disclosures, both quantitatively and qualitatively, and that's something that I'll touch on later on in the presentation. Okay, so our next industry, we're not going to do a back and forth for this one. I'm just going to speak to some considerations relating to software. there is going to be very similar 5-step process, but various special considerations just because the software industry does have some special things going on with it. I think overall what I concluded when preparing for this portion of the presentation is for the software industry, and I think many others too, this guidance is ultimately, it's loosening the requirements and generally will result in revenue being recognized sooner. And I'll explain why in each one of these steps. So step 1, identifying that contract with the customer. The new guidance is much less driven by the form of the arrangement. It's not as nitpicky when it comes to that kind of thing. Even something like an email could represent a contract. So I did want to make sure I mentioned that. Also, when it comes to collectability, we talked about collectability being one of those 5 criteria that an agreement has to meet in order to be considered a contract. Well, price concessions are quite common in the software industry, and I just want to make sure that no one confuses that with, oh, there's collectability risk. That's really a separate issue, and price concessions are considered under the 3rd step. Hopping to step 2, identifying separate performance obligations. So this is particularly pertinent in the software industry because typically those contracts, there are a lot of different products and services that could be rolled into a single contract. So determination is going to have to be made which of those are distinct and should be accounted for separately versus all rolled up and accounted for together. So we spoke earlier on to how this new guidance blows out all the industry-specific guidance, and I think this is a really good example of that. The software industry had this concept of vendor-specific objective evidence that was required in order to recognize revenue on certain things, in order to break them out separately in order to recognize revenue. And now that concept of VSOE has gone away under this new guidance. Let me get this advanced. Okay. All right, I don't know whether that was me or whether that was Mark, but one more consideration under step 2 is IP licenses. And there's a lot that the guidance speaks to as to whether a contract includes an IP license, and if it does, is that considered a right to use intellectual property or a right to access intellectual property? And those determinations would impact how the later steps are applied to the contract. All right, step 3, determining the transaction price. Once again, this concept of loosening. Under the current guidance, if a fee is not fixed or determinable, you are not able to recognize revenue. So some of these software agreements were written in a way that maybe revenue couldn't be recognized until closer to the end of the process. Whereas the new guidance is much more open to the concept of estimating, doing something that you consider most likely, or that kind of thing. So again, I think you're going to see, if you're in the software industry, you'll probably be able to recognize revenue a little bit earlier in the process than you would under the existing guidance. Okay, step 4. So once again, that concept of VSOE, vendor-specific objective evidence, it's not really something that you need anymore to allocate contract consideration, and instead our keyword here, that standalone selling prices should be used. They may need to be estimated since, as I've mentioned, oftentimes these products and services are bundled within the contract. I also wanted to point out there's no hierarchy for how to estimate a standalone selling price. One way is not considered in the guidance as being better than another for doing that. Okay, and then moving to step 5, the actual revenue recognition. So I spoke a lot last year about the point in time versus over time revenue recognition, and that was what several of my examples spoke to. So just applying that in the software license example, so if that license were to provide a right to use intellectual property, typically you have point-in-time recognition when that license is provided. If that license provides a right to access intellectual property, generally you'll be recognizing revenue over time, over that full term of that license, as opposed to at the very beginning of the process. When it comes to implementation projects, and I was thinking about when Kathy and Jim were speaking, these long-term implementation projects maybe that you're a software company and you're helping your customer with, how do you go about recognizing that revenue over time? And really you want to select a method that best reflects the transfer of the goods or services. That's all I wanted to mention on software, and I'll kick it over to Mark for construction.
Thanks, Erika. Well, I was going to do another costume change and maybe put on a hard hat, but it gave me bad memories. John Yannick's daughter got married in this very room, and I have bad memories of him doing YMCA with the construction helmet on, so I'm going to avoid that. The construction and engineering industries have historically recognized revenue using the percentage completion method of accounting. And while there have been different methods for doing it historically, and there continue to be different methods for doing it going forward, which we'll touch on, fortunately, in most cases, I think that's going to continue to be the case. I think when this literature originally came out and they said they're wiping out all of the industry-specific information, people kind of were wondering, well, what the heck's going to happen with construction contractors? But fortunately, as you'll see when we get on to step 5, we will generally see people using percentage completion method of accounting. So we're really going to go through the same five-step process. I want to talk about some different considerations that are specific or unique to construction contractors as we go through here. So step 1, obviously a construction contractor is going to have lots of different contracts. It's going to be very different than in our manufacturing example where we had one standard contract for every sale. So you're obviously going to have to evaluate the different contracts. For the 5 criteria that Erika mentioned earlier, commercial substance, approval, identifiable rights, identifiable payment terms, collectability, and really each contract may need to be specifically evaluated. On step 2, I want to talk a little bit about separate performance obligations. Obviously, construction contractors can have a contract that covers various different scopes of work. And you may even remember from some of the examples in the literature that really the literature asks you to carve out different performance obligations and allocate consideration to those different performance obligations. When I originally read that, I shuddered a little bit and thought, boy, some of the contract status reports I see at my construction contractors are already pretty long. Are they going to have to split those up into a bunch of sub-jobs? And fortunately, I think the answer to that is generally no. There will be cases where you'll have to split that up, but the literature also includes an example of a contract where essentially a contractor was building a facility. They were responsible for piping, wiring, installation of equipment, finishing, and overall project management. And so your gut reaction to that might be, boy, do they have to account for each one of those, the piping, the wiring, the installation of equipment, as separate performance obligations. Fortunately, the example in the literature concludes that they don't have to account for those as separate performance obligations. And the rationale it gives is because there's that contract management function and because the contract is responsible for kind of tying all 5 of those pieces together, and removes the risk of doing those things separately, that you might have a disconnect, that entire contract is accounted for as one performance obligation. So there may be times if you're, if you're pouring one concrete pad on this site and another concrete pad on that site and there's no contract management, those might be 2 separate contracts, but if you're really doing things that are integrated, it's going to generally be one contract. Under warranties, Erika touched a little bit on warranties earlier, and really to the extent that the one thing I wanted to touch on relative to warranties at construction contractors is if you have some sort of maintenance agreement that you would call a warranty in a construction environment, if that's something that really could be purchased separately and is not a part of the regular contract, that would be carved out as a separate performance obligation. Obviously, step 3, determining the transaction price. Obviously, change orders are common in the construction industry. Practically, I think change orders have generally been added to the existing contract. You're increasing both the costs that have been incurred, and you're increasing the forecasted cost to date, and you're including that in your new percentage of completion calculation. This new literature says that you really want to think about those change orders and offers 3 different possibilities. And one possibility, you would treat those change orders as a separate contract. Really, when you would do that is if it really is a separate, distinct obligation with a separate standalone price. In that case, you're going to treat it as a new contract. Another case might be that the services are distinct from what's already been transferred under the old contract, but the modifications to the consideration is not based on a standalone price. In that case, the literature recommends that you terminate the existing contract and begin a new contract. And then the third possibility would be to continue the existing contract. If you are a construction contractor and you have change orders, I'd recommend that you take a look through the examples in the literature, because I think there are some helpful examples relative to how you should treat change orders, and probably will help you in making these determinations. We talked a little bit about variable consideration earlier. Some things that you might run into in the construction industry for variable consideration may be awards or incentives for completing a contract ahead of schedule, or penalties for completing a project behind schedule. As Erika mentioned earlier, when you have variable consideration, you're required to estimate the pricing. You're required to estimate the impact of those and roll those into the contract price. So as she mentioned earlier, there are a couple different ways to look at that variable consideration. One is a most likely value method, and the other method would be more of a probability-based method. So you could use either method there, depending on the facts and circumstances. Really, when you decide between those two methods, you have to pick whichever one is the most optimal predictor of the amount to be received. And you're really supposed to consider both the facts and circumstances of the contract as well as your experience in the industry with similar items. And I would say kind of under all of this, determining the transaction price, to the extent that you have unsigned change orders, the new literature also wants you to consider the probability relative to those unsigned change orders as well. As far as separate performance obligations, as we mentioned, if you have separate performance obligations, you need to take a look at what the standalone pricing is for those separate performance obligations and allocate the consideration based on the standalone pricing. There are 3 approaches outlined in the literature. One is a top-down approach where you would take a look at the market value for each of the services you're offering and use that. Another is a bottom-up approach where you would kind of take a look at the costs and the expected margins and build it up that way. And then there's also a residual approach. Step 5, as I alluded to at the beginning of this section, control is often transferred over time in a construction contract, and the literature really talks about control transferred over time in three different pieces. One is if the customer receives and consumes benefits as the contract is performed, you would be considered to have recognition over time. If the contractor's performance creates or enhances a customer-controlled asset, you have control transferred over time. That's probably most frequently in the construction environment. You're constructing a building for someone on their location. You're really enhancing an asset that they control over time. Or an asset with an alternative use to the contractor is not created, but the contractor has the right to pay for performance. So you're doing it probably at your location, but you don't have an alternative use, and you have the right to demand payment. As I mentioned, there's obviously percentage of completion basis accounting is still in play, and that would be, really fall under the input or the output method. The other method would have to do maybe with a different measurement for progress. So whichever method most faithfully depicts progress is the method that this literature wants you to use, whether that be an input method or an output method. So whether it be like a cost-to-cost percentage of completion method, or if it be like a units of delivery type method. It wants you to use the same method for each performance obligation consistently in similar circumstances. I wanted to touch on significant inefficiencies in performance because this is probably a little bit different than what's happening in current practice. Historically, if you run into issues on a job, let's say we're doing a small $20,000 job, we've incurred $10,000, so we're 50% complete. However, we run into a snag the next day, and we have $10,000 of inefficient costs. So if you were to just continue to calculate that the way we have historically had, you'd say, okay, we know the project is no longer a $20,000 project, it's a $30,000 project. We're $20,000 into it, so we're 67% complete. What this literature wants you to do is say, rip that inefficient $10,000 cost out of the calculation and say, we're $10,000 in to the $20,000 project, and that other $10,000 is going to be disregarded for purposes of calculating percentage of completion. So we would go back to being 50% complete, under this new literature. I think that may be an important consideration to the extent you have contracts that go off track, and I don't know too many contractors that don't occasionally have projects that go off track. As far as contract assets and liabilities are concerned, for anyone who has ever had to write, say, or type cost and estimated earnings in excess of billings on uncompleted contracts, or the opposite, billings in excess of costs and estimated earnings on uncompleted contract, I was pleased that they decided to use the words contract asset and contract liability in the literature. It rolls off the tongue a lot nicer, don't you think? Another area that's worth noting is uninstalled materials. So I think in practice, a lot of construction contractors get materials on site. That's considered a cost of the contract. It goes into the percentage of completion calculation, really the day it's delivered to the site. This clarifies that to the extent that you have uninstalled materials at the site, that those should be really treated more like inventory than contract costs. So I think that'll be kind of a cost-benefit analysis on how folks are looking at that in their day-to-day accounting. But to the extent you have a material amount of uninstalled materials, those should really be treated more like inventory. Pre-contract costs, you have costs of obtaining a contract. Those can now be recognized as an asset and amortized as long as they're expected to be recoverable. As a practical expedient, you can expense those as incurred if the amortization period is less than a year. Mobilization costs, in some ways similar to the inefficient costs, to the extent that you have mobilization costs associated with the job, they really want you to pull those mobilization costs out of the percentage completion calculation too. So let's say you have a $1.1 million job and it's going to take you $100,000 of mobilization. You shouldn't just have the mobilization. You really have achieved nothing on site relative to completing the job and say that you're 10% complete. So they want you to pull the mobilization costs out of the percentage completion calculation. And with that, I will turn it over to Erika to talk a little bit about disclosures.
Okay, great. Before I touch on that, just one thing I wanted to note with regard to what Mark was speaking about, the costs of obtaining a contract, being able to capitalize those. That really is applicable to any industry, not just construction contracting. So that is one area, again, where accounting could change under this new guidance. If you pay some sort of sales commissions upon winning a contract, that can now be capitalized on your books instead of expensed. And that does apply to any industry, so I just wanted to make sure I made that clear. But going into the disclosures, so under the current guidance, there are not really very many required revenue disclosures. You might even have something as brief as revenue is recognized when products are shipped, and that's the end of that. But under this new standard, there are numerous required disclosures, some being quantitative, some being qualitative in nature, that we wanted to get on your radar. One good thing for those of you in private companies, you can make elections to opt out of some of these required disclosures. So there's 4 areas that we want to touch on. One is the disaggregation of revenue. So whether you're a public company or private, there's going to have to be some sort of disaggregation of revenue disclosed in the notes to the financial statements. Public companies are encouraged to use more than one category when they're disaggregating their revenue. Private companies are really only required to break your revenue down in one way, and that is the timing of the transfer of goods and services. So that, again, is about that over time versus point-in-time recognition. You will be required to quantitatively disclose what portion of your revenue is recognized at a point in time versus over time. And maybe for some of you, it's all one or all the other, and it's not going to be that difficult of a disclosure. You're also going to be required to disclose qualitative information about various economic factors and how they impact revenue recognition. So again, that's not something that will be easy necessarily. That's something for you to think through, because it's not going to be a one-size-fits-all. It really is going to be specific to your company or your organization. Second area, contract balances. So those are the contract assets and liabilities that Mark was speaking about, or even receivables from customer contracts. And there's not quite as much you have to do from a non-public standpoint here. You would only have to disclose opening and closing balances of those, whereas if you're a public company, there's going to be a lot more that's required of you, including some analysis and explanation of the significant changes there. All right, thirdly, performance obligations. So you'll have to disclose some things generally about the performance obligations contained in your contracts. If you're a public company, you're going to have to get specific as to, at 12/31, whatever year, here are our specific remaining performance obligations at this time. But from a private company standpoint, you wouldn't have to go that far. And then finally, disclosure-wise, so I think hopefully Mark and I have illustrated how there are judgments along the way to exercise with each step of this process. Well, now you'll be required to disclose how you made those judgments, what they were, and what you were thinking about. So from a non-public standpoint, just to hone in there, so once again, if you're recognizing revenue over time, you're required to disclose how you did that, how you determined your methodology for that. We also talked a little bit about variable consideration and how you're required to estimate some things there. You also are required, if your variable consideration, if you think your estimate is constrained, if you think, oh, you know what, there's really a chance that I'll have to reverse revenue if my estimates are off, you'll have to disclose those types of situations as well.
As far as adoption methods are concerned, there's two methods: a full retrospective method where we would restate all prior periods, and a modified retrospective, which is where we would essentially adjust retained earnings at the beginning of the year. I would note that under the full retrospective method, there's like 3 practical expedients that you can use in doing that. So you're going to want to take a look at which is going to be the best method for you. I think somewhat surprisingly, a lot of the public companies, I think, chose to go the full retrospective route. I suspect that a lot of private companies may go the modified retrospective route, but that remains to be seen. Just a few final notes as we close out. Remember, there will be impacts of the revenue recognition changes. There may be tax impacts. Generally, the tax returns are following, GAAP. Usually, book income is the starting point for the tax return. You could have impacts on covenants. So make sure as you're looking through your revenue recognition and making a plan for that you think about any impact on covenants. And also, I suppose it could have an impact on compensation, depending on how your compensation structure and perhaps bonuses work.
Okay, and to close us out, I think there will be a range of possible impacts of this guidance. Might be a very minor impact on your company or your industry, or it could be more significant. Again, it's the final countdown, January 1st of 2019, if you're a private company. So when the clock starts on this. And we really do encourage you to start tackling implementation, including those disclosures that we touched on at the end of the presentation now, just to ensure that you've collected the appropriate amount of information throughout the year. So I think that wraps us up today. I think we're going to